Thanks again, Dale. Thanks for this terrific first session. We're now going to begin our second and always terrific session with CEOs from around the country, giving us some real insight to what's happening out there. And I'm going to turn it over to Randy Rowe, who's been a terrific partner of us in this conference for the past 10 years. Thanks, Randy.
Thank you, Jay. So this morning we have assembled an all-star panel, and as Jay said, all CEOs of their respective businesses, although I guess in Mike's case, former CEO of his respective business. And collectively we're going to cover a variety of property types and also the financing markets, et cetera. But as has been our custom, we're going to start with Roy, who's going to do an overview of the broad capital markets. Roy, as I think everybody knows, is the president and CEO of Eastdil Secured. Also on the panel to my left is David Nethercutt, the president and CEO of Equity Residential, who will bring a broad perspective, obviously, in multifamily. We'll see if he and Sam share the same perspectives. I assume they probably do, but
he's a brilliant man.
And, I think you're smarter than him for saying that.
And there must be stock grants involved or something. And Deborah Cafaro, who obviously runs the largest healthcare-oriented enterprise in the country, Ventas. She's chairman and also CEO. And then Mike, who's now the former president and CEO of Vornado, one of the most aggressive acquirers of property in the gateway cities over the last number of years.
And actually, Mike, this is like your last event, right?
It is.
So I brought you a little something for your new job here. Trophy husband.
I finally achieved success.
You achieved success.
Is that do you want to marry me?
Beth did not send that.
Mike, it looks like it might be a little tight. Beth may like it, but you may want to.
I hope it's your size.
My trophy husband, I'm going younger.
So with that, we're going to let Roy give us an overview and set of context, and then we'll come back and we'll have the panel have a discussion for about a half hour, and then mindful of time, we'll try to leave at least 15 minutes for questions at the end.
Well, I thank you very much, and I think that Sam's obviously a lot more optimistic than he's leading on. We didn't have one F-bomb during his presentation today, so I think we're off to a good start. Lots happened, obviously, as Jay pointed out, in the last 18, 19 months since October 4th, 2011, when we were together, and the whole theme then was really volatility. And as I was speaking, I think I commented that the Dow had moved over 200 points 18 different times, and in fact had moved that morning the 19th time. And I went back to kind of look at some of the things that we had talked about then, and I'm going to comment on those as we go through this very quickly today. I'm going to try and keep it to a short 15 minutes if we can. If it's a little fast, understand, and the slides will be available. But some of the same questions that we had then, which is where can we find decent returns? Are these cap rates sustainable, and could they even be headed lower? How long will rates stay low, and how fast might they ultimately correct at some point? And how does, which we commented on before, a global pension system earn 7.5% in this rate environment? And when will we see significant job growth, and how will that ultimately impact interest rates? And is this European situation finally under control? The positives are that the Fed's determined. There's this growing desperation to find yield and a real capitulation in the fixed income markets. The lack of return and concerns ultimately in the back of people's minds over inflation have more than offset any of the job growth concerns, at least as it relates to valuation, particularly for primary market core assets. Interest rates are likely to remain low for an extended period of time, and we'll go through a little bit of as to how long that might be and how to gauge it. Financing costs are falling quickly as the CMBS markets are strengthening, and ultimately the banks are back in business and seeking earnings, and they have a tremendous shortfall to make up relative to their deposits versus loans. And real estate continues to outperform other asset classes. Cap rates on a relative basis to bond yields we think are still relatively high. Concerns, when they do move, rates do move fast, particularly when they rise. Slow job growth and slow Asia growth is an issue. Outstanding Middle East turmoil is an issue. Continued European struggles, and in particular the low growth environment and dislocation there does have an impact on where we operate here in these states. And this continued push on taxes ultimately will have an overriding effect on investment. And then the Dodd-Frank risk retention rules will have a big impact on CMBS. So those are the concerns that we have. Now, interestingly enough, when we met last time, the S&P had dropped 24%, and the VIX had risen 99% from July 15th of 2011 to October 4th of 2011. Today, the S&P is at an all-time high, and the VIX is at its 6-year low. So relative stability, even though it feels like it's been a little bit more of a jerky market. Bond market continuing to predict low rates, 2.6 for the next 3 years. I'd only point out that 45 days ago it was 2.9%, and 75 days ago it was 2.25%. The conundrum we still think is facing the CIOs, because they have to be fully invested in order to keep up with this return criteria and their actuarial requirements. And as you can see with the 165 10-year Class A core real estate at a 6% IRR continues to deliver superior returns on an unleveraged basis, almost 3.64 times 10-year treasuries. And with even a modest amount of leverage at a conservative rate, 10-year IO at 3.5%, it is 5 times the treasuries. And so we think that that's continuing to push, and we feel it in the core markets, investors, particularly pension funds, to get into the market. The private pension gap is soaring. How big is the issue? $347 billion in the private pension plans alone that they owe retirees, and this is what they ultimately have to come up with in terms of what they pay them. So we think there's going to be continued push from the pension fund market. Ultimately, U.S. REITs as a proxy has outperformed other asset classes, 86% versus the NASDAQ at 44 and S&P at 42. And then if you look at this just from 2012 to present, the most interesting thing is while we've outperformed it on an overall return basis, 33.3%, if you look at the dividend yield, we've also had an attractive current return at 3.45%. So overall, a healthy and robust environment, as indicated at least by the proxy of U.S. REITs. By sector, retail, industrial, hotel, and office have outperformed apartment, but only since 2012 because apartments have performed so well in the interim, and David will talk a little bit about kind of where we are in the cycle with multifamily. As you'll see when we get to valuation, there is a healthy return, in fact, having penetrated the previous highs on valuation from a valuation perspective. Still cap rates versus BAA yields, a watershed or a bellwether, if you will, for where cap rates might be, still significantly below where ultimately we think they can go. 86 basis points is where it's been since 95, and we're at 126 basis points today. Meanwhile, just looking at this little chart here, and we're operating obviously from a low base, but clearly, 10-year treasuries moving 30% in 20 days has a pretty dramatic impact on people's psychology. As you can see, it's drifted down again, and we're around 165 today. What does that mean for the debt capital markets? A lot of liquidity, significant CMBS demand. If you recall, when we were here last, we talked about the fact that the July 15th downgrade, not only of the U.S. government debt, but also, if you recall, S&P had made a mistake in the rating of one of the CMBS issues, and ultimately it caused a dislocation in the market. There's tremendous demand now in the marketplace for conduit and single asset execution. Strong life company bank demand, increasing demand for longer durations. We're starting to see 15, 20-year plus durations coming out of life companies in particular. And as a result of this flood of liquidity, we're seeing covenants and terms and conditions beginning to loosen up, including increased prepayment flexibility, growing availability for transitional assets, and a significant spread tightening. Again, just a snapshot, again, us as a proxy for the market, about $33 billion worth of product that we've done since January 2012. About 40% of that was CMBS market, 18% of it was life cos, with 29% of that being in the U.S. banking system, offshore banks making up the rest of it, along with finance companies and debt funds. Predominantly in the office space, about 48% of which was done in the office space, about 21% in retail, and 19% of it, surprisingly, in the hospitality markets. The Fed, feeling like they can't go any lower relative to directing the federal funds rates, have come out with a couple statements that have tried to provide the market with a little direction. On September 13th, basically suggesting that fund rates are likely to stay exceptionally low through mid-2015. And then on December 12th, they basically gave us a real roadmap that they're going to continue to keep low Fed funds rate as long as the unemployment rate stays above 6.5%, and inflation rate is projected to be below 2.5%. What does that mean? This is a little matrix that the Federal Reserve of Atlanta and the Bureau of Labor Statistics has. You can actually go on the site and figure this out. And this basically monitors labor participation rate against job growth. And as you can see, given the current labor participation rate of 63.3%, and 168,000 jobs created over the last 3 months on average, it would take us about 2.2 years to get to that 6.5% unemployment rate. Now, this is much more of a linear calculation. Things don't happen that way, but it's interesting to kind of watch this as a potential guide for the future. This is what I was referring to before, and some of you have seen this. Back in December 2007, the number of loans to deposits were 93% in the U.S. banking system. And while one would conclude that there are fewer banks that are ultimately likely to be in the business of loaning, we simply see that today, at a 70% participation rate, loans to deposits, about $2 trillion of lending capacity is in the system overall, of which only $1.3 trillion are in commercial real estate loans currently. That looks like a shortfall of approximately $500 to $600 billion of loans that could go ultimately into the commercial real estate area if they were to proportionately go as they have historically. Again, fewer banks out there to do this, but it does indicate that there's an extraordinary amount of capacity in the U.S. banking system. The CMBS market, again, reflective of 2011, we were looking at $33 billion last year. We got close to 50. We expect over $85 billion, with $30 billion already issued year to date. And this is what the bottom line is relative to where the loan pricing is today. 5-year fixed at 50%, 2.85%. A standalone CMBS deal is at 2.5%. So for the first time in a long time, we're seeing standalone CMBS inside of life companies and banks. All the way out to 70% LTV. And then on a 10-year basis, 3.2 to 3.35% for 50% LTV. And under 4% in the CMBS market for 70% LTV on a 10-year basis. And if you drop down for those assets that ultimately banks will lend on, ultimately you're seeing that you can borrow, in essence, 60% at 2.6%. So when we look back on that from 2011, the 10-year 60% was about 5% at that point in time. So it's come in 150 to 175 basis points. The equity market, again, liquidity, very active. Cap rates are stable to falling, in our opinion. Pricing has recovered to 2006 levels, and in some places it's actually penetrated those levels. Unique assets continue to draw capital from around the globe. And pricing, in our opinion, doesn't fully reflect yet the strength of the debt markets. In other words, the debt market has gotten cheaper faster than the equity cost of capital has. Ultimately, the market continues to look for quality and security, but there is a reasonable spread between true trophy and other Class A assets. There is a growing appetite for assets with upside and transitional, especially if they're at a reasonable basis. And we still think there's a material spread between primary and secondary markets. Ultimately, it was driven by the CMBS market. We think that the CMBS market will begin to narrow this gap. There's cautionary tales around whether the CMBS market should or shouldn't be in some of those markets. But ultimately, the underlying fundamentals will drive that as well. This is, again, a snapshot of where Green Street looks at their commercial price index, and we're at 100.4% versus the peak in March 2007. So at least across the core assets, which are predominantly within the research sample that Green Street carries, we're back to peak pricing, in essence, across those assets. Apartments and malls have actually penetrated their original highs, with the strip centers coming close. Industrial, office, and hotels still lagging somewhat, but as you can see, not by a lot. Malls are 14% beyond their peak. Apartments, 10% plus. Coastal markets, one would argue, even more. Strip retail is right in there, and we're guesstimating strip retail and industrial will likely be at 2006 levels before the end of the year. Office continuing to lag somewhat. Again, if you start looking at some of the primary markets, 24/7 cities, we're likely through the peak at this point in time. Lodging still a laggard, although if you look at RevPAR across most of the lodging sectors, they're getting back to peak in major markets. Sales volume, $45 billion year-to-date, quarter 2013. We expect to be back to in essence, 2006 levels. When we were here in 2011, we were guesstimating in October that we'd end up the year at about $148 billion. We ended up at $153. So we've been fairly close relative to guesstimating when and how these ultimately end up, but we expect that we'll be back to 2006 levels of transaction volume. 2007 was an anomaly. Obviously, that was the year of EOP and the multiple trades that came through that. This shows by product type kind of the total in 2007, along with a snapshot of by product type where we are. The biggest laggard continues to be in the office space and the hospitality space as a proportion and on a percentage basis. Where's the capital coming from? REITs are up. The private markets are down. Cross-border is up, and the institutional and equity fund is down. We ultimately think that that will increase, particularly with a modest use of leverage. Public markets, balance sheets are strongest they've ever been, cost of capital at an all-time low, and there's a massive dedicated and non-dedicated inflows and an expansion of the ETF markets, ETFs, which are driving the market. It's been the highest equity issuance volume in the first quarter since 2009. Recall in 2009 it was basically a defensive raise. This is all offensive capital. This is my reminder that I don't go too long, so I don't get the hook from Randy. Recent IPOs have worked, especially in off-the-run type of property types, and we're continuing to see the outperformance of small mid-caps as the non-dedicated market has been chasing value and yield. We expect, as a result of this, that there's going to be an increased flow of M&A activity in 2013. Evidence of the fact that these balance sheets are in great shape. About $130 billion of equity has been raised since 2009, 2010. And I believe that 2013 will ultimately be a record year for equity issuance, at least in the current cycle. Snapshot of where REITs are versus the private market real estate based on where Green Street pegs it. About 22% premium to the private markets and the public markets. That's 14.6% on an unlevered basis. Candidly, the number that is more attributable to what we'll call the core asset classes, office, retail, industrial, and hospitality, has been closer to 10%. But asset classes like senior housing, healthcare, and net lease have actually outperformed the market significantly, which is why the overall market is up 22.7%. And I'm sure that Deborah will have a few comments on that, having outperformed the market for the last 13 years significantly.
And it's still an anomaly according to Green Street.
Yeah, exactly. Well, they don't get everything right? So this is just a snapshot again in summary as to kind of where we are versus the peak. We're going to talk a little bit later about kind of where the spreads are, but basically the spread between gateway and suburban markets is about 200 basis points today on an IRR basis, and it was about 100 basis points in 2007. In terms of mall retail, As you can see, we've penetrated the peak, and we're looking at deals that are in the low fours for the best malls in the country, and closer to 6.25% IRR on those for over a 10-year period of time. Open air retail, pretty close to where we are actually inside from an initial yield perspective. Grocery anchored, same story, a little bit wider still on the suburban markets, about 70 basis points versus the peak, whereas on the core, we're really back to where we were in the gateway cities. Industrial, right on top of where we were at the peak. Multifamily, again, on top and through where we were at the peak, particularly for coastal markets. And then hospitality, the going-in yields are about the same as they were, but still 150 basis point spread against the peak over a 10-year period of time. So conclusions, investors continue to pay up for trophy assets with cash flow and lower risk. Debt markets are strong now with the CMBS market setting the pace and actually being inside of the bank and life company market. We think that the sustained low interest rates are going to create an itchiness in terms of the capital needing to be invested in finding return. Don't know where cash is yielding quite as much as where we are today. Public markets continue to signal a further value increase in our view. Concerns over future inflation, we think, encourage people who have that issue in the back of their mind to put it towards real estate, as it feels like a hedge against that. CMBS markets, we think, will continue to close the gap between gateway markets and other top 30s. We saw the CMBS market developing in the major cities first, and now we think that they're going to be able to go into the other top 30 markets, and that's going to create some compression relative to returns. As I said, the pricing doesn't fully reflect the strength of the debt markets, particularly in these non-gateway markets. We think that the economically sensitive pricing is going to improve. Still opportunities to manufacture to core. That's development, redevelopment, broken balance sheets, broken capital stacks, and the like. Activity, we think, will increase this year, and while we won't be back at 2007 levels and the anomaly that was created in 2007, we think that it will be increasing because of the debt maturities that are coming due in 2013, 2014. And I guess the last thing here is, and that is just beware of the complacency, given how fast rates can change and the issues that are out there, including the European challenges, the Middle East turmoil, and ultimately job growth issues. So with that, Randy, turn it over to you.
Thank you. As Roy said, he always makes available this wealth of data afterwards. And I'm trying to remember, is it done through the DLA website, or how do we do that, Roy? It's through Roy?
He's got a call.
I was making
you
sure I was
give them
off.
a link to Roy? Is that how you do it?
Yeah, just send it to
Okay. So anyway, because obviously there's enough data there, we could have spent the whole session just on Roy's presentation. I guess, and I always find the contrast between Sam, who tends to be a little bit dour, and you, that always thinks it's a good time to buy. So it's always a good way to
well,
to
whether it's
approach it,
caskets or bassinets, we've got the wood.
I know. All right.
And when Roy said it's not a good time to buy, run.
It means he's retired and he's now buying. So, but anyway, I'd like to go to each of the panelists in their core areas first and just get an overview of what's going on. And I thought I'd start with Deborah. And the whole healthcare sector has had a phenomenal run, and you've been very, very acquisitive. And it appears you're spending a lot of time working on your balance sheet and all the rest of the things that a CEO should be focused on. How do you feel about the next 5 years? Are you going to be able to be as acquisitive? Is this attractive to you? Does Obamacare factor into this at all in terms of how you're approaching it? Where do you see things going from here?
Okay, thank you. So you're right, we have been really acquisitive at Ventas. We're now up to about $30+ billion in enterprise value and over 1,400 assets. I would say that I can't predict out 5 years. What I do know is there's tremendous demand for senior housing and healthcare assets driven by demographics. It's a little bit different from David's story in multi, but they're both really demographically driven stories. The over 85 is the fastest growing, and they're in the seniors housing and nursing home sectors. And then the baby boomers are really customers of the medical office buildings, and the medical office building business actually benefits from some policy changes too, one of which is Obamacare, which will drive 32 million more uninsured people into the healthcare system in a regular way. And then you have the 79 million baby boomers becoming Medicare eligible starting last year and using the medical office buildings. So the benefit we have in healthcare continues to be demographic demand that's inexorable. The other positive I would say we have as a REIT and an acquirer with a low cost of capital is that unlike some of the other sectors, it's $1 trillion market, it's growing, and it's still very fragmented, and the amount of assets in public hands is about 10%. So very different from malls, say, in the U.S., where probably over 60%. So the opportunities to continue to acquire are there. So what are some of the things that we're looking at, though, as we do believe we have lots of opportunities to continue to grow. We're very low leverage. I would say that we continue to look, as cap rates have fallen, at replacement costs, because I would say as cap rates have fallen and cash flows have grown, that's an investment criterion that we're often seeing as a warning sign, I guess. And the other is, in the government reimbursed sectors, the positives are there's more demand, there will be more utilization, more people will be covered, so to speak, but that has to be paid for. And some of the providers, essentially our customers and tenants, are paying for that. The nursing home operators, the hospital operators, through cuts in their rate growth. And so that's the other issue that I think balances out a little bit of the ebullience. But in general, I would say it continues to be very positive for growth. Our cost of capital has fallen faster than cap rates, and so we continue to acquire in most of our sectors.
Keep the pedal to the metal.
All right. We'll come back, I think, to cost of capital in the broader sense we get to it. So, Mike, for a number of years, you've been very focused on the gateway cities, particularly D.C. and New York. And while you've had a variety of property types, you've been very heavily into office. And you heard the earlier panel where Sam was not optimistic that office has seen all of its pain, and Jerry was not as enthusiastic about it as I thought he would be. How do you feel about office in the gateway cities these days, particularly the ones you're active in?
Clearly, first of all, if you look at Roy's presentation, you have to just think, is this a better time to sell than it is to buy? I mean, I think that's the first thought when I was sitting here. You hear Roy, every 18 months, and I talk to Roy a lot more than frequently than that. And it seems like a lot of things have to go right to make a decent return. And basically, it's just if you look at those charts, that's one question that comes immediately to mind.
Wasn't leaving Vornado the ultimate sale?
We sold like how much did you sell for us last year?
$3 billion.
$3 billion. So we sold a lot of stuff, a lot of crappy stuff we want to get rid of too, and some good stuff.
It was all beautiful stuff there. Our children were beautiful.
I have 3 kids that they say they'll let me explain. The thing about, I think, the office sector that Sam said, I think is not, Sam never lets facts get in his way, but I think last year 22% of the tenants in our buildings expanded, not contracted, to Sam's point. But if they were going to take 50,000 feet extra, they might have only taken 10,000 feet extra, or 25, because there's indeed a trend going on to get more efficient. There's no question that the reason why you haven't seen office rents, I think, go up that you might expect with supply being cut off all this time is because people have gotten much more efficient in the use of that, whether it's hoteling, whether it's the law firms eliminating library, they have virtual office, they take Deborah's picture, then they take David the next day put his picture. That's a big downgrade, but it's just different. And people want to get value today too. High-priced office space is very tough to move. Where in the hedge fund go-go days, if you could get a hedge fund $140 space, they say everything more expensive. It would be like the bouncer in the club, nobody inside. It felt better waiting in line. It's some trends that are going on that are definitely headwinds for office, but I might say that it might be a contrarian bet right now because it's been like this for quite a while. And my experience is those things always revert back to the mean. So right now, office has tailwinds, and it continues to have demand, but the demand is not as robust. But supply will be a long time in most cities before they can build stuff that will support current rents. So,
have you seen any
anecdote to that is the Sony building in New York, right?
alternative use. So.
Which, you know, but when you look at the owner, Sony, is their headquarters 830,000 square feet, looking to shrink to 500,000 square feet. Ultimately, wanted to move to cooler space, given the nature of their employee base and the nature of their business. And so they signed a 3-year lease, basically, and are going to move out of 100% of that building. And the building is going to go to an alternative use, which is going to be residential and retail, which is an existing use but expanded, and then hospitality, high-end hospitality, ultimately. And they're going to end up taking 500,000 square feet, so the downsizing, but they're going to take it in Midtown South or on the west side, likely, and looking for a more creative environment, which speaks to the type of use that people are looking for as well.
For a bunch of years, Mike, following up on the office, D.C. looked like the never-lose market because the government was expanding at such a rapid rate that it just seemed that whatever was created was absorbed. Are you seeing with the attempts to rein in government and sequestration any impact at all, or what are you seeing?
Sure.
In terms of
The biggest impact we had was BRAC. It was the base realignment, closings that occurred. And Dave and I have talked a lot about the residential market in D.C., which we have a significant amount of apartments there. And that's been a better market than I think a lot of people give it credit for over the last couple of years. They were expecting a big tail off. But I've been probably looking at investing in D.C. heavily since the late 80s. And I've never seen D.C. as slow as an office market today. I think it got the huge benefit of the stimulus in New York and D.C. During that shot that, the government put so much stimulus into that economy, into New York, that we saw rents actually go through that cycle going up in D.C., which is probably the only market in the country that was true. Then you've seen rents in D.C. have not fallen, which is shocking to me, but the activity level and absorption have gone way, way down. So you would think the price decrease would follow, but even if you cut prices 10%, I'm not sure velocity would be any higher. People are not making decisions. They're waiting. Contractors with defense, subcontractors. It's a very much a market that's in neutral. It isn't getting horrible. It's just kind of not going anywhere. So it's the worst I've seen the fundamentals in D.C. And clearly the pricing, though, if you try to buy an asset there, doesn't reflect that.
Right.
Yep.
David, multifamily was probably the early darling of the recovery. It really took off before the rest of the market. And while Sam points out that there has been a lot of new supply in any of the property types, it does seem multifamily is most actively beginning to produce some new supply. And obviously that's market specific, and there are higher barrier markets and lower barrier markets. But do you spend any time these days, worrying about the supply that might be coming in some of the markets you're active in?
Well, there certainly is a lot of supply. And we did benefit for several years of that lack of new supply at a time when people were not moving out to buy single-family homes and they were just hunkering down. So through the Great Recession, our occupancy stayed strong. And coming out of that, we did do extremely well, having 2 consecutive years of plus 5% revenue growth, and we had never had 2 consecutive years in our history. There certainly is more supply coming. And a lot of people look at the headline sort of national sort of numbers. We obviously spend a great deal of time looking at our own markets. But when we look at expected household formations in these markets, we see, we think satisfactory incremental demand to absorb that new supply. We don't see these markets getting destabilized whatsoever. We see a lot of product coming online in these markets that had sort of been inventoried. I think we've got a 2 or 3 year backlog of product that's now getting done and coming to the market. We didn't have any of that for years. Rents went up, occupancies went up. And what you look at what's coming now, based upon and compare that to the continued strong demand from that segment of the population Sam had talked about, and the desire of that segment to live in the markets where we're focused, we see those properties being absorbed. And just to put it in an absolute, if you add 1% to the base and you don't occupy a single one, your occupancy is only going down to like 94.5. So we're still in a position where we're moving around. So I'll take D.C. as a class example. We're looking at the new supply in D.C. as being very sort of sub-market and very neighborhood focused. So in D.C. today, with new supply coming, we've got some properties where our cash flow may be off 3 or 4%. We've got other assets in those same markets, but not in that same neighborhood, where we're up 3, 4, 5%. So we're looking at it to be a very neighborhood, very sort of sub-market centric phenomenon, and we just think that long-term that demand will be there. We're looking at, we've got 41% of our units are occupied by a single individual. They're just not moving. Retention is up. This segment of the population, I think, really values the optionality and flexibility that rental housing provides. So while certainly we've got more supply coming, and I think some neighborhoods, some markets might be disrupted for short periods of time, we think they'll be absorbed and the markets will be back in equilibrium soon.
Well, let's move to a discussion of capital. Sam was talking about, obviously, the historically low interest rates, at least compared to most of our careers. And when I look at 2007 and look at today, one of the things that does seem to be related is that in 2007, transactions began to be driven by the cost of debt and the levels of debt. And it really became the primary driver. And at least we've seen a number of transactions recently where that seems to have been the primary driver. Are you each seeing that in your respective spaces? And I guess I'd start with Roy and work back around. Yeah. I mean, how much do you see that as, are these all equity buyers, or are you seeing debt setting the pricing?
No, significantly, we're beginning to see, obviously the core buyers are looking at 45 to 50% LTV, and they can borrow, candidly in the kind of low threes to maybe breaking 3%, depending on the product type. But you can also borrow 85% LTV in this market at probably 5.25 today. And so if you kind of look at where 50% LTV up to 85% LTV, good rule of thumb is maybe 150 basis points per 5% of leverage level. But again, you can borrow 75 to 80% at somewhere in the 4 3/4 range today.
It's interesting. In the Sony building, to Roy's point, we thought you'd get $600 million of debt. And one of the big office companies' first bid was $810 million. I was talking to the guy, and they ended up with $900 million of debt on the building.
Right.
Well, obviously, someone's going to pay more than $810, right? And so that transaction, even though it was an alternative use, wasn't stable, no cash flow, went to huge LTVs, but it went $200-300 million more of debt, Randy. So let's not forget the cost of the debt, the availability of the debt. So you're starting to see it. Particularly in New York, you have a really fascinating trend. Alternative uses. If you can sell an apartment, we bid in the Sony building. We bid to what I thought was the outer limits of the plant, and we lost by, we couldn't even find us in the flashlight, and because someone we thought was expensive was looking at, I'll convert it to apartments, and I'll sell it, I'm buying it for $1,300 a foot, I'm going to sell it for $3,000, $4,000, $5,000 a foot. There's a building where the crane is. You guys familiar with where the crane, where we had that when Hurricane Sandy? That building, they're saying they're averaging over $6,000 a foot to sell condos. Now think about that. 2,000 foot apartment costs $12 million. So if you have, on our building, we have the exact same views. The highest rent we ever got in the building was $144 a foot gross. So take $40 off your 100 net, cap it at 5, it's $2,000 a foot. 4, $2,500 a foot. They look like we're playing the wrong sport. We're playing lacrosse when all the action is in, tennis or golf. And they say, what are you idiots? Sell it and convert it to condos. So we have an anomaly going on. But I think the availability of debt first and the cost of that are driving prices back to the 2007 type levels. Because it's not being driven by the fundamentals. And the more you know, the less you bid. You know, it takes somebody coming in, you know, from outer space and say, you know, it was 110, I'll project it. But so if you're in that market every day battling it out, you're not going to.
Aren't those people the ones that are paying $6,000 a foot for these condos? I mean, all these people from abroad and.
Well, 70% of the buyers in that building have been foreign because they're doing it for other reasons. They think it's cheap, there's currency.
Right.
As Sam said, they want to get the money out of China or Brazil.
Russia.
You know.
Yeah.
We all read a thing where they said 5 years ago that Miami Apartments had a 20-year supply of apartments, and that they were the single worst investment idea anyone could possibly have because there was a 20-year supply of it. 5 years later, there's no really non-commodity apartments, and they're back above the peak pricing for waterfront. Now, commodity stuff hasn't recovered, and that's another tale. You have to be very careful.
Yep.
Commodity stuff is not recovering, and unique stuff is.
Yep.
Well, some might say Bernanke's getting exactly what he wanted from the policy, which is risk on.
Yep.
So in that
Yeah,
respect.
exactly.
What about in the healthcare side? Are you seeing debt driving your pricing and your transactions?
Well, we'll take a different tack on it, and David and I both have in our sectors Fannie and Freddie debt, but if you look at the public REITs, we're about 30% levered. Debt's probably about 10 years. David borrows more cheaply than we do, but in the 3-ish plus or minus 25 basis points
and
for 10 years.
it drives her crazy.
It does.
It drives her crazy.
So that's the 10-year bond issuance rate. The institutional grade market is just on fire, again, driven by the same things that Roy talked about. Fannie and Freddie are probably for senior housing in the 4-ish plus. And so that really is not capital that the REITs are using. But if we sold assets, that would certainly be capital that the buyers would potentially use. It is their cheapest cost of capital. And then oddly enough, on the nursing home side, which historically we've put no leverage on at the asset level, HUD has been offering kind of 30-year fully amortizing, 3+% financing. So that may start.
So we're subsidizing you now too.
So that may start to generate some transaction activity in that market. Although HUD financing is, you would rather poke your eyes out with rusty knitting needles. I mean, it's so terrible. But that is a unique aspect, I would say, of our market. So.
David, I guess we'll go to the Fannie Freddie thing because I'd like to know if you're seeing the same thing. What we've seen in the manufactured housing space has been that Fannie has gotten tougher on the coverage issues relative to the way they underwrite, which means that they're ironically prepared to provide more debt today on a weaker asset than on a stronger asset because the stronger assets trade at the lower cap rates, the weaker assets trade. Are you seeing any of that at all in the apartment business?
They're very much concerned about refinance risk. So I'm surprised to hear these 85% LTV sort of transact. So we've been a huge seller of assets. We'll sell $4 billion or so of assets this year. Significant amount of that in the first quarter to help pay for our.
Yeah, you bought a few too, though.
Yeah.
We bought a little bit.
Exactly.
And Freddie and Fannie have got an enormous share of financing of the stuff that we're selling, but they are underwriting to a refinance level of 7.5 or a constant of 7.5 or 8.5%. So that is really putting a ceiling on the valuation. So when Roy says that you've seen sort of core coastal market multifamily values back to peak or above, you're not seeing that in the markets, in the commodity markets that we're selling. And that financing level is putting somewhat of a cap on it. So people are getting great deals on the stuff we're buying. I mean, we're selling kind of on average at a 6% cap rate, and they're financing in the in the high 3s and 4%, and getting a terrific spread. The other thing that's somewhat of a limiter there is the replacement costs in those markets. And so what we're selling in Atlanta, in Orlando, and in Phoenix, and places like that are probably $120,000 or so a door, which we think is 10 or 15% below what peak might have been for those assets back in 2007 at a different interest rate environment. So we are certainly seeing the Freddie and Fannie liquidity allowing there to be a lot of velocity in our business, but we're not seeing it creating any sort of bubble pricing on the product that we're selling.
Yeah. And I just to clarify, as it relates to the higher leverage levels, these are not whole loan lenders that are doing that. When you get past 70% LTV, you're really dealing with equity players and mezz players who are ultimately stepping in, who are very comfortable, in essence, in the equity position themselves, but just calling it mezzanine debt.
See, I find that interesting, because we're seeing something a little different. It may just be the asset categories we're in, that take the Fannie situation, Fannie caps out at about 70% these days on the high quality stuff. The CMBS market, though, is less coverage constrained, and they're much more willing to take market trades as being the value. And so that the more you bid, the more capacity you have. And so the CMBS market, we are seeing on first mortgage basis in the 75 to 80% range. And that is a significant change from 12 months ago.
Right. But what you're seeing is they're selling off that most junior piece in the capital stack, generally to debt funds and equity investors.
But Randy, just in this conference last night, somebody asked me, they're buying an asset at 4.5%. Their logic quickly was, I'm financing it at 3.5%. I'm getting 70% debt. My cash on account yield is 7.5%. I'm underwriting it back end. I'm going to get double digit. So
Mike, yields never go down. I mean,
right. So
cash flows never go down.
You have to. There is a lot of driving of pricing by that math, whatever that math is in each product sector. There's positive leverage, even at these low cap rates for most people, unless they borrow to the mezz level.
Yeah,
right?
It's called whiskey and peyote.
Whiskey and what?
Peyote.
Is that the bassinet or the coffin?
So we have a little bit less than 15 minutes left, and I promised to leave time for questions from the audience. So at this point, let's move to the audience. Do we have questions from the floor? If not, I have other questions. But anybody else?
It's got to be guts.
Not a single question in the room.
Okay.
Put them off to sleep. Let's get more entertaining.
So let's wake them up. Okay, well, my next category I was going to move into was more about what we started to cover here, which is the whole issue of the spreads between markets, the spreads between asset qualities, the spreads that we all look at all the time. And I was also surprised, Roy, by your comment about still seeing 200 basis point spreads traditionally. I don't know if that's across geographic different markets, which I would see that we see more of, or if it's between quality, because once again, because of the CMBS financing availability, we've seen the spreads tighten a lot more.
It's more geographic than it is quality, because the CMBS market and the core markets in particular have moved into that space. Again, I think you need to be very careful in terms of looking at what these differentials are and deciding whether or not the CMBS market's actually going to come in to fill that, and whether the fundamentals ultimately justify bridging a portion of that value spread. Again, if you look at 2006, 2007, the CMBS market was financing across the board and brought equilibrium, in terms of returns. Really, suburban, urban, 24/7, and 24 nowhere. And so I think that today they're beginning to move out because they just can't find the product. And with the bank market coming back and the life company market coming back last year, if you track 2012, the life companies were getting through their allocation disproportionate to the time of year in terms of chronology, and took a little bit of a break over the summer because they felt like rates were getting a little bit too low and a little bit too much demand. By the time they came back in September, the CMBS market was back in full bloom, and ultimately they actually had trouble meeting their allocation goals for 2012. And so at the end of the day, you're seeing 20 to 25% more allocation in the life co markets. You're seeing 20 to 25% more coming out of the bank markets. And the CMBS market, again, we think is going to be $100 billion this year, $85 to $100 billion, up from $48 billion last year.
And as far as you can tell, is the CMBS paper now back widely being bought by the broad market, or is it being bought more by niches of the market?
It's increasingly broadened. It's not all the way back to kind of full CDO investors, but it is broadening as people are searching for yield. Again, these guys have to get invested. And if you look at how long it takes to make up the spread between a 1.65 10-year Treasury and being able to get into a piece of paper like this at call it 4.5% to 5%, it takes a long time to catch up.
So, David, given what Mike referenced in New York of the alternative uses being much more highly valued than his office uses, you have to have some of the same issues relative to apartments versus condos. Have you spent any time looking in some of the hotter markets at that arbitrage?
You know, we were actually in the condo business back in 2005, 2006, and taking advantage of that arbitrage ourselves. And it was actually in the commodity markets where we were able to turn, you know, $100 into $125. So we were doing condominium conversions in Florida and in Phoenix, really getting rid of product that we knew we didn't want to own long term. We've not, we got out of that business, made a lot of money on it, and wound that business down. We have certainly expect that market to come back, and I think we believe it will come back conversions more quickly than many. You know, I don't think that we'll get back into that business, but it wouldn't surprise me at all if there weren't opportunities to, you know, turn some of our better quality apartment properties into have someone else do a conversion of that. Whether that's the right thing for us to do or not, I don't know. Believe me, these things are hard to come by. We've fought tooth and nail for the past half a dozen years to get the concentrations in these high-density sort of urban markets that we're at, and I'm not sure that we'll trade out of those too terribly easily.
So, Randy, it's really interesting. You know, I was, you know, I've had, you know, my last day of Veneta was April 15th, which was the 16th year anniversary of the Mendick deal when we bought Mendick. We also bought the merchandise mart right after that, if you remember, here in Chicago. I took out my files and I really went through this mathematically. I looked at the average rent we bought Mendick was $25.82. It peaked at about $77.80. So, you know, not capital. That's how you make money over a long period of time. You take the rents from 25 to 77. We bought the merchandise mart, and I had a file in my file when I was at Goldman. I did the Chicago Stock Exchange. I went back to 1986 and 1997 in Chicago. The average rent was the same. Basically, the gross rents were a lot higher, but the net rents were pretty much the same during those period of times. You cannot make money in the office building business if that happens unless cap rates go way down. So if you have the double whammy if cap rates, rents went up. So you look back at these things, we make money by raising rents. David's business is great because they've been able to push rent a lot. Cap rates reflect it. If you stop buying at 4% and rental growth's not there, you are dead. And in Chicago, we eked out just over 10% compounded IRR on the merchandise acquisition from 1997. With a lot of ups and downs and volatility, you can decide whether that's a good or bad, you know, IRR. Pretty good multiple because it was over a long period of time. But it's, you want to be in, now we did benefit from cap rate compression there. You know, if we didn't have that, we would have a much worse IRR.
That was the broader yield curve change over time.
So you have to raise rents, and particularly in capital-intensive businesses, maybe not healthcare or apartments, these office buildings, TIs, leasing commission, downtime are really expensive. Roll is only good if the rents are going up. You know, it's a pretty, this is not that intelligent a business. You wouldn't all be here if it was that intelligent about it. You know, pretty simple business. You know?
I think Mike makes a good point, and this is an area where, again, apartments, and as we've looked at senior housing, and we've talked about that, we've got, with the demand, I mean, NOIs in the higher quality markets, in the higher quality assets are growing in the high single digits, you know, multiple years in a row. And I agree with, you know, occupancy growth and rate growth. And I think when we talk about cap rates, sometimes we lose the concept of, you know, also what's it a cap rate on? And I think we've tried to push cap rates in senior housing lower toward multifamily. Again, some similarities, some differences as well. But the idea of where can you get an asset that's a 6 cap, but also is growing NOI 6, 7, 8, 9% a year. I mean, that's a pretty darn good investment. And I think when you're talking about spreads, you have seen the spread in the cap rates compress between a senior housing asset and these other asset types, but for very good reason. Good performance during the downturn because they have a need-based aspect, and then the ability to continue to raise rents and also to increase occupancy as the economy is improving and as the housing market's improving, et cetera. All those things are very supportive of this continued kind of NOI growth.
Randy, the other thing that's factual in Chicago, when I look back, the best rise in rents in the Chicago market were on Michigan Avenue for retail. By far the best growth rate in this market over any of those two periods of time. And I had numbers on these different deals, which I actually sat there and calculated the average compound. You look at New York, we have $222 million of income coming from street retail at Veneto. The average rent we bought that portfolio was $200. Today, it stands at almost $2,000 a foot.
Oh my God.
So you make a lot of money when rents go from $200 to $200 to $2,000, And now Fifth Avenue rents are over $3,000 a foot.
Yep.
Times Square rents are over $2,000 a foot. So that's not to buy it, that's per foot to rent it, So it's a lot of money. I come from Providence, Rhode Island. That's a lot of money from there. And the truth is, the only thing in Chicago that's come close to that was Michigan Avenue, where there was fixed supply, there were volumes over there in terms of rent. Nowhere near the growth in New York rents, but still a pretty good business. And that was our single best business over the 16 years I was at Video. Number one, the retail, because rents were up so much relative to our own projections. We had no idea that we didn't predict that. It just happened. Now,
So Mike, stay with that. You've been selling off the malls, and
the malls did not do that.
And so
not our malls, at least.
Well, I'm just saying that. So you've made the decision that going forward, you're still a board member. So going forward, that the street level retail is still a good play, even at $2,000-3,000 rents.
Right.
But that you've decided the malls are not as good a play on a relative basis.
I think the other thing is we can manage the street retail better. And I think we found ourselves not managing our malls as well as Simon could, or these big mall guys, which had leverage. We had a trophy mall in Kings Plaza, but it's a mixed demographic area. It did $700 a foot. But the costs were over $100 for CAM costs because it's just a very tough, expensive area to with rents. I mean, with CAM, you had over $100 a foot. And we sold that mall at a very attractive thing. But Macerich thinks they'll make that long. They have a better opportunity to manage that than even we do, I would say. So we've made a thing that we're probably better at managing the strip retail. I mean, that as well as city retail. And the malls has become, as I think Sam said, it's become pretty good at oligopoly.
Do those tenants actually make money paying those
No.
rents? So this is just you need a flagship, so you need to be on Michigan Avenue.
money
or
in
Fifth
The
that
Avenue.
retail
way.
tenants, you mean?
Yeah.
They average up. If you look at the Uniqlo store, they paid $2,000, $3,000 on the ground.
Which one?
The Uniqlo.
Okay.
But they pay $200 for the basement at $150 for the second floor. So they average their costs down. If they do the kind of volumes they do, they'll make money. But we have a store on Madison Avenue where the rent's worth $1,100 to $1,200 a foot, and their sales are $845 a foot. So they're not making money in that store unless they have a new accounting from a good accountant. So
What did you underwrite the overall return on that retail condominium at 666 when you purchased it? What was the IRR on that?
we about 8 to 9% unlevered. But we got a 3.6% mortgage for 10 years.
But Mike, I find it interesting that you talk about how things over time can come back to their means as a reason for all of this.
Time cures all ills in real estate.
But with the retail, going from 200 to 2,000 is a pretty good move. So you see the 2,000 going to 20,000.
I'm scared shit. I have no idea. You know? I mean,
That's why he's leaving.
if I could predict the future, maybe I'll come back in my life and do that.
Okay.
And maybe Deb will even then consider me even if I'm not young.
All right, last chance. We have time for one question if anybody has one. Otherwise, we're going to wrap it. Perfect. Thank you very much. If you thank the panel.
You're welcome.
Thank you, Randy, Mike, David, Debbie, and Roy for a terrific presentation. We're going to take a short break. We're going to reassemble back in this room for a panel on the Washington impacts in real estate and across the hall on our deal panel. So please be back in by 11. Thank you.